scale? What is the value of prioritizing precision instead? How does a deliberate strategic reset allow Tune Protect to pivot from volume to elite profitability? What is the ultimate payoff when a business chooses strategy over optics? This is Money Matters. Hi there, good evening and welcome to Money Matters. I'm Zahir Kelvin Ong Abdullah and you're with us on TV3, where you can also stream on Tonton. The decision to prioritize strategic precision over market volume has defined Tune Protect's results for 2025. To speak in detail about this, Group Chief Executive Officer of the Tune Protect Group, Kim Lian, joins us today. Welcome to Money Matters.
Thank you, Kelvin.
Can I start off by asking you, looking back at 2025, how would you describe the year for Tune Protect?
I would say 2025 is a very eventful year. I think for us, we started the new strategic focus and direction starting second half of 2024. 2025 is basically the full years that we started to see the initial result of what prioritization of these three strategic pillars start to deliver results, I think, for us. That we see our bottom line basically have grown more than double, I think, in 2025 year on year. Hopefully, I think we can sustain this performance and really be able to deliver return basically to our shareholders. Yeah, that have been actually with us all these years.
Okay, so looking at that, were there any particular strategic changes that you had to imply in 2025?
I guess one of the three key strategic pillars are all talking about balancing the portfolio. Insurance, I think, emphasizes a lot of a balanced portfolio rather than to grow the return premium at all costs. Yeah, because insurance generally is just insuring unforeseen events. So I think having a high return premium does not always translate into a high profitability or bottom line. So 2025, we spent a lot of time actually rebalancing our portfolio. We actually reduced, I think, the loss-making portfolio and replenished that with a highly profitable travel portfolio. So I think during the year, we see we actually trimmed down almost like 47 million of lower profitability business and replenished that with about 32 million, I think, travel portfolio, which are highly profitable and which eventually, I think, deliver the results, I think, of a successful turnaround.
Right.
I think
what was the loss-making portfolio?
Okay, there will be different sub-segments. For example, so I think, just give you an example, let's say car insurance. Not all car insurance are actually loss-making, but certain car insurance, private car, for example, with certain loss ratio, low sum insured category, specifically in Peninsular Malaysia, East Malaysia. So those generally have a relatively high loss ratio as compared to others. So while having a higher weightage, I think, on that segment, it will actually drag down the overall profitability. So we need a balance of higher sum insured, lower sum insured, motorcycle, and East Malaysia to balance that portfolio.
Okay, so having said that, is there a different strategy that Tune Protect does in terms of in West Malaysia as compared to East Malaysia?
Basically, we actually leave it to the commercial decisions that we actually price it accordingly based on the loss ratio. So we actually offer, I think, certain segment the lower loss ratio, a lower pricing in order to grow the segments actually a bit more relative to a high loss ratio that we'll be holding true actually on the premium. The premium will be regulated. And we are actually spending a lot more effort in growing our travel portfolio, which I think during the year of 2025, we have seen more than 25% growth year on year on our travel portfolio. That actually rebalance out the whole profitability, I think, of the company.
Okay. Can we move on to talk about yield over volume? So overall gross written premium, GWP, declined slightly by 3.7%, yet the travel segment, as you mentioned, grew like you mentioned, very strongly. If my figures are correct, it's 25.6%. Yep. What does this shift sort of tell us?
I guess it's showing us the initial result of our strategy, which is what are sustainable growth that is going to be our strategies. So as I said also just now that it was through a conscious decisions of us trimming down some of the less profitable segments we actually trimmed down approximately 47 million of businesses which we think that are less profitable to us. And we actually replenished about 32 million, which are highly profitable to us. And that has already shown an initial result of how the 2025 result turned around. So I think maintaining that discipline, it shall allow us to actually position very well in a position to regrow the business back in a more balanced and profitable and sustainable way, I think, moving forward.
Right. So moving forward, the travel segment will be your main focus.
I guess travel and beyond. In 2025, one of the key achievements is also how we rebalance motor portfolio. Motor portfolio, I think, when we talk about portfolio balancing, we do not mean that only do travel and not motor. Even what we meant is that within motor, there are multiple sub-segments. Like, for example, I think maybe to a lot of people, they may not be aware, like motorcycle profitability is better than actually private car. And private car for a certain sum insured which is lower, certain age and above, actually the loss ratio may not be as great. So I think in 2025, we managed to achieve more than 14 percentage points of improvement in our loss ratio, I think, on the car insurance segment itself. So car insurance now become a profitable segment, actually, for Tune Protect. We are then in a good position to regrow back the whole motor portfolio as well, over and above travel.
Right. So let's talk about the ecosystem play, because based on reports, you have consistently spoken about going beyond insurance, and you also mentioned this earlier. So how did that sort of materialize in 2025?
I guess 2025, it also showed us quite a positive result. We have grown about 6 times higher in our ancillary incomes. Those are non-insurance incomes. I think as of 2025, we actually recorded about more than 20 million additional incremental revenue coming through this non-insurance segment. That is going to be able to supplement and improve our competitiveness against our competitors, because we have a diversity of income sources to allow us to be, from a pricing angle, to be more competitive. From a customer engagement angle, customer can engage us to actually purchase product and services beyond just insurance. I think one of the good examples that we were quite proud of, I think, which also won us an award, was actually how we bring in delay launch pass into Malaysia. We are the first one to launch delay launch pass. So when your flight delay, our insurance gives you the added advantage of you can enjoy the launch facility while waiting for the flight. So that benefits actually not only giving the good experience to our customer, that emphasis on experience, rather than after the event you can always file a claim and then you probably wait for 1 week later and then you get your money. We are talking about on the spot experience, how it is your experience in waiting. And from there also, because we source from different suppliers, we also actually able to fetch an incremental income, which is actually what the supplier gives you some feedback, some rebates, I think, on some of those services. It's a win-win situation for both our insured customers as well as our supplier that actually are able to expand their market.
Okay, Mr. Hao, hold that thought. We've just got to go for a break. We're talking to the Group Chief Executive Officer of the Protect Group, Kim Lian. Stay with us. Welcome back to Money Matters. We're picking up our conversation on the Tune Protect Strategic Reset with Group CEO of the Tune Protect Group, Kim Lian. Now, just looking at what you mentioned earlier, travel has been strong, but how are you ensuring the overall portfolio remains balanced?
Okay, maybe let me first clarify. I think a balanced portfolio does not mean that we only do travel and not do other line of businesses. It's just every different line of businesses in insurance, there are always sub-segments. How do we maintain a healthy sub-segment? I think so. Travel, for example, the more profitable one could be a single trip. The less profitable one could be annual plans. How do we maintain a healthy travel portfolio? I mean, in that sense. So I guess there's no rocket science. I think to maintain a healthy portfolio, it generally requires a lot of disciplines in underwriting, I think, all these risks. And how our way of doing it, actually, we started actually in the second half of 2024. So we changed the KPI of our management teams from measuring gross return premium, which is top line driven. We actually introduced something what we call value dollars. We reward management based on healthy portfolio, which are profitable portfolio. So you can grow your gross return premium, which is revenue, by 100 million. You may not receive any recognitions unless you are actually recorded a positive value dollars, I think, for us. So that is what we started to see some initial sign of discipline actually across the management teams in emphasizing healthy, higher positive value dollars in 2025, which translates to the result.
Okay. So let's talk about the regional footprint. So how does your regional footprint support this strategy that you just mentioned?
I guess when I first joined Tune Protect, I always find that Tune Protect have this, the biggest value of Tune Protect is unlike any other insurance company. It's actually the 34 countries, territories coverage. It's a very unique propositions to most of the multinational players, because multinational players generally they have a distribution network across multiple countries. For them to be working with insurance partners in different countries is always going to be a pain, I think, to them, because I have a coverage of 20 countries. How am I going to be working with so many insurance providers? And Tune Protect actually well positioned at a very sweet spot. We can activate all the 20 markets for them, and they only need to work with one partner. I have the coverage of 34 countries. I have a single technology platforms that you can do one single API with me and activated all these 20 countries. I have the reinsurance license that will be able to offer you a same product benefit pricing across 20 different countries. So that itself is the key unique selling propositions that is always just going back to us. How do we bring ourselves in the international space to create the awareness and then for people to be willing to work with us with this very strong proposition that I do not see from most of the other insurance companies.
Right. So how do you pick your strategic partners overseas?
I guess it's two-way. So we believe in not merely going and acquire all kind of partners, because partners, they are also partners that are technologically more prepared and technologically not so prepared. I think one of the key criteria working on international business or regional business is we can only distribute via digital platforms. It has to be 100% digital. So partners that are actually very digitally prepared or savvy, they will be able to work with us very closely to test out, to work on the UI, UX, to test out how do we optimize the take-up rate, how do we optimize the journey for the customers. Whereas certain partners that may not be so ready, typically they take a very long time in actually doing any implementations. So one of the criteria that we actually in selecting partners, one is we always look at what is the value add I can bring to them on the table. Are they operating in multiple countries that overlap with our network? Then the second criteria is actually how much do they believe in actually this UI, UX on the customer journey, that they can really work with us through this and optimizing and maximizing the benefit of APIs with us. how it can create a different journey and experience to their customer. I think these two are very important criteria when we're actually selecting partners. Yeah.
So you've mentioned very strongly just now about the digitalization. So in a competitive insurance landscape, so to speak, with other insurance companies who are also looking at digitalization, what differentiates Protect from them today?
I guess the key thing is every time when we work with the partners, our tech integration API are all 100% in-house developed. So we have been doing this thing and successfully supporting, I think, of course, my key partners in Asia. Anywhere that they fly to basically are supported by us, I think, behind the scenes. So we have experience working across different jurisdictions requirement. Whereas I think compared to some of our other insurers, not all insurance companies are able to do that. In fact, I think a lot of the companies are still relying on third-party supplier to enable the tech integrations actually for them at different countries. So I guess that is a very unique, I think, propositions that actually we have, that we are quite ready, and in fact, I think we are also potentially more ready than a lot of other players. But I guess the biggest challenge to us is always the branding is something that we need to probably need time to groom the brandings, and not just only looking at local Malaysia's market, but started to adopt something which is further. I think what we have developed in Malaysia can become something which is so valuable even in the international space to be so competitive.
Okay, stay with us. We're talking to the Group CEO of Protect Group, Kim Lian. Stay with Money Matters. Welcome back to Money Matters. Let's look at the 2026 roadmap for you as you move into 2026. How does the strategy evolve from here? Because we're just into the first quarter, so moving ahead.
Okay. I guess strategies, we are not changing our strategy. We see our strategies to be really working and start delivering results in 2025. I think we only have 3 key strategic pillars. We're keeping it very simple to our teams. So the first is basically underwriting disciplines that we value, and we actually measure and reward our team based on a profitable portfolio. The second, basically, strategic pillars was talking about growing international space. How do we actually optimizing the networks? Because international space, we are 100% digital. Any business flowing through would not give me the incremental cost. So we just want to groom, I think, our brands beyond Malaysia shore, I think, to actually bring in more partners from international partners to use our network. And the third pillar was pretty much what we believe in, vertical expertise. And we started to create, we form mini teams. For example, travel managed to achieve a 25% growth. It was partially through these teams what we have created. We call that Travel Task Force. What they do, they are actually consist of all the functional nominees nominated by different departments and form a vertical team. And we actually train them to groom them to understand the travel industry. So understanding insurance is not good enough. You need to understand travel industry. You need to understand hotel, understand airlines. Then they can start talking about the same language, I think, with the partners and understand their pain points. So what they managed to, or how they managed to deliver 25% growth was pretty much through their success in increasing the take-up rate for the same partners that we worked with 1 year ago and 1 year after. They have demonstrated more than 50% take-up rate improvement. So for the same thing that you're displaying, how do you attract the customer of our partner to purchase, to click? So we have a 50% improvement in click rate. We have 7% improvement in average premium. The premium can go higher, yet more people will buy because you are giving them the right type of protections that they actually wanted. So we believe that in 2026, well, strategy-wise, we will not be changing, but we will be moving into our second phase in terms of initiatives in each of these pillars. On the GI pillars, or what we call discipline in underwriting, what we are going to be doing is that we are going to replicate this model of this vertical structure from travel, from motor task force. Now we hope we can replicate this success actually into more line of businesses to allow us to better connect to our partners and our customers. So that will be moving into phase 2. And the second part of the phases is actually beyond insurance that we keep talking about. Beyond just giving ancillary income, I think 2025 what we did was we launched a launch pass, we launched a cancellation for any reason, we launched even travel eSIMs. Beyond just doing this, in 2026, we are going to expand it further to become creating an ecosystem. We will be onboarding more players or more merchants into our ecosystem to offer all kinds of services that travelers in their journey or their trip, they may require, whether airport transfers, they may require that, etc. And the third pillar, of course, is basically we're going to continue to invest in the technologies to adopt how AI and automation can allow us to be more efficient in handling claims from multiple countries in different languages. How are we going to be able to do it more efficiently? Yeah.
Right. It sounds really, really challenging. As you move into 2026 and beyond, your key strategic priority, your main focus, shaping Tune Protect's next phase of growth?
I guess the whole teams in 2026 that we have, I think, gone through with our board is pretty much to regrow while maintaining the discipline in underwriting. The key things that of what we are going to be doing and betting on in our midterm from 2026 onwards is building ecosystems. We believe in increasing the engagement, I think, with our customer is going to be very crucial. And what the customers need will not be restricted to only insurance alone. Like you may buy our car insurance, but what the benefit you may want, it could include car parks, it could include car wash, it could include tinting discounts, vouchers, and that is what we are moving towards in creating the ecosystem for drivers, ecosystem for travelers. Hopefully that we can increase the engagement with our customers, and that will promote a better loyalties, I think, with the customers and attachment rate. Yeah.
Okay, Mr. Hao, thank you very much for being on Money Matters. It's been a pleasure having you with us.
Thank you. Thank you for having me. Yeah.
For the past half an hour, you've been with us on Money Matters. If you miss any part of today's program, you can always catch it up on Tonton. Be sure to join us next week, same time, right here on TV3. I'm Zahir Kelvin Ong Abdullah. Thanks for watching. Have a great weekend. And to our Muslim viewers, Selamat Berbuka Puasa. Bye for now.